Good afternoon, everyone. Welcome to the Research Analyst Career Track of the PJFIS 2021. The future starts now. If you want to post about the conference PJFIS 2021, please don't forget to use our official hashtags. Yes, we have hashtags so we can trend. That's one is hashtag PJFIS 2021. The second is hashtag the future starts now. The third is hashtag CFA Society Philippines. So three hashtags, hashtag PJFIS 2021, hashtag the future starts now, and hashtag CFA Society Philippines. Whether you're posting on Facebook, Instagram, LinkedIn, pwede rin TikTok. And as a reminder, the evaluation form is available on the CFA Society Philippines mobile app. So we have an evaluation form for you each day of the conference. So this is part of the requirement for you to get the e-certificate. And please don't forget that you need to attend 70% of the whole summit or 13 sessions to get the e-certificate. So we have a number of attendees today, 100, so about 120, quite a big group we have today. And I'm sure a lot of you are excited to hear about or find out what a career as a research and investment analyst is. So for this afternoon's breakout session, we'll be having a panel discussion from seasoned analysts in the industry to answer frequently asked questions about their role. So we have for us, for this panel discussion, we have an equities analyst at Sun Life Investment Management and Trust Corporation, covering consumer gaming and related conglomerates. She is a CFA charter holder, a certified public accountant, and a certified trust officer. Prior to joining Sun Life, she was a sell-side research analyst with over 3 years of experience. She graduated from the University of the Philippines, Litman, with a Bachelor of Science in Business Administration and Accountancy. So let's give a virtual round of applause for Ms. Melanie Ong. Melanie, thanks for joining us this afternoon. We're excited to hear from you.
Thank you.
Joining Melanie is adding to the panel is a CFA charter holder and investment analyst covering ASEAN +3 bond issuances for a multilateral credit guarantor. He previously covered domestic and foreign equity markets for 6 years and was the equity research director at China Bank Securities. Let's give a virtual round of applause for Mr. Garie Ouano. Thank you so much, Garie, for joining us this afternoon.
Hi, thank you, Miguel. Good afternoon.
And rounding out this panel is currently the assistant vice president at RCBC, an assistant vice president at RCBC Trust and Investment Group, where he serves as the pioneer senior investment advisor, providing research and analysis on various investment outlets around the globe for RCBC stakeholders. So he started his career at Union Bank of the Philippines as a management trainee before specializing as a portfolio manager, a role that also included the functions of research analyst, fund strategist, and asset trader. As a portfolio manager, he managed the portfolios of high net worth individuals, institutional accounts, and UIPS. He also expanded his knowledge on the digital space as a product manager under the Blockchain Center of Excellence, where his team launched the award-winning Bonds.ph app. He graduated with honors from the Ateneo de Manila University as a management economics major and graduated with distinction from the Asian Institute of Management's Master of Science in Innovation and Business program. He has been a CFA charter holder since 2018. So let's now give a virtual round of applause for Mr. Ram Cervantes, CFA. Thank you, Ram, for joining us this afternoon. Thank you. And moderating this panel discussion is an investment analyst at the RFE Group. He is a finance professional who is focused on value investing, bottom-up analysis, business-like investing, and other fields related to buy-side investing. He graduated cum laude in the University of Santo Tomas, batch 2016, and was awarded the CFA Charter in October 2020. So let's now give a virtual round of applause for our moderator, Mr. Juno Fragante, CFA. Thank you, Juno, for moderating this discussion.
Thank you. Thank you, Miguel.
I'll now pass the virtual floor or the air to you, Juno, for the panel discussion to moderate. So take it away, please. Thank you.
All right. Thank you, Miguel, for the introduction. So, yeah, I want to greet all the audience there. And yeah, first, if you have questions in mind, feel free to post it in our question Q&A box, and we'll answer that later on. And as we have discussion, if you have questions in mind, feel free to post your questions. And I know you'll learn a lot from our panelists, from actual practitioners, and I hope you'll gain a lot of insights from them. So sit back and relax and be with us and be with our discussion. So I'm just curious, of course, everyone, the first and foremost question is why, right? So I want to ask our panelists, why this role, or how did you become interested in your current role? So I guess Sir Ram.
Yeah, sure. Hi, good afternoon, everyone. Hope my audio is coming in well. Let me know if it doesn't. In terms of why, well, I would like to give a shout out. Hopefully, I have a couple of people here from MECO, but I graduated from Ateneo. I took up macroeconomics. My homework was MECO, and I learned about financial literacy there. I had a lot of opportunities to learn about stock trading and also about teaching like kids how to save, yung mga nanay, how they can start investing some of their money into their businesses. And it made me feel like, okay, it seems like this is something that if I had my way, I'd love to get the opportunity to keep learning about financial literacy. Because I mean, to be honest, who doesn't love money, right? But also the fact that, hey, maybe if I'm able to gain something, if I become more knowledgeable, it would be interesting to pass that on. So that's how I really got started. What got me interested is that, okay, getting returns is great, but also paying it forward is something that I wanted to look towards. And thankfully, over my career, I got the opportunity to really get more knowledge. And now, in my role as senior investment advisor, I get to also impact some people's lives. Hopefully, in my head, making returns for them also means maybe giving them better retirement, maybe giving them the opportunity to go on vacations, buy something that they weren't able to buy before, or help augment their daily living. So those are the things that made me really interested in my role.
Wonderful. Yeah. So Miss Melanie.
Hi, good afternoon, everyone. Yeah, so I'm a research analyst at Sun Life. So basically, I think that what got me interested was, well, my first job in college after graduating was in the sell side research in equities as well. So it was a natural progression. And the reason why I found it interesting was I like numbers, and at the same time I like to write. So I think the as a sell side research analyst, and even as a buy side research analyst now, those two skills are what I use every day. Also, as a naturally curious person, being reading the news and being updated with the ongoing developments of different corporates, that's something that naturally got me interested in the role. Being in the capital markets, it's every day is different. There's always something going on. I think it kind of like stood out to me as a different and interesting kind of job versus, I guess, doing the same thing every day. So that's basically why I got into this role.
Wonderful. Sir Garie.
Hi. So for me, I'm currently a credit analyst, but I also started out as a sell side equities analyst. And I guess how I got interested in that as a first job is it started with a class really. We had a financial econ class in UP, and it was really interesting. And because of that class, I decided to try out the virtual trading simulator of the old Philippine Stock Exchange website. It was an HTML website, but they did have a trading simulator, and my capital was virtual, but I earned virtual money out of that. So I just wondered how could I earn this in real life, and that's really how my interest in equity started. So mostly it was just following curiosity.
That's great, right? So yeah, of course, curiosity will is always a great trait for everyone, especially in this field. Uh, Before I move on to the next question, I just remember, Miss Melanie, you mentioned buy side and sell side. Maybe you can share to our audience or explain to them. Maybe some of them still new to that terms.
Sure. Yeah. So in the sell side, usually you work at a stock brokerage, and typically the role is you're publishing research reports for your clients. You're sort of pitching to them your recommendations, ready to buy, sell, or hold a particular stock. And in the buy side, you're similar in a way to sell side, except that your responsibility is more towards guiding the portfolio managers towards making sound investment decisions. But yeah, similar skills. Just yeah, it's just more of like you are on the client side for the buy side.
All right, so thank you, Miss Melanie. I think that's an important question as well when you're starting in a career. So of course, personally, me as well, it's important to distinguish first, where do I want to go, either to the buy side analyst or sell side analyst. So thank you for that, Miss Melanie. And my next question to you, can you share to us your typical weekly routine as a research analyst? I'll giving the floor to you guys. So maybe Sir
Sure. Part of my role, honestly, is double hatting. So I think a lot of people who are working right now, they have to kind of stretch themselves a little bit, right? So half of the role is being a retail portfolio manager, trying to book the investments of these clients, trying to get all of those deals done. But to get there, to even get them to sign on for a transaction, it takes a lot of groundwork, right? You develop that relationship with the client, you do a lot of research, as mentioned by Melanie earlier. You do have to be relatively curious, right? Because you're going to have to check the news, find out what's happening, try to also delve down deeper and see what are the interconnections there. What are the pieces of information that are actually news versus noise, which is something you're going to hear a lot when you talk to finance people. Finding out which are the best investments or best securities per asset class, or even which asset class you should be exposed to in the first place. And then I think the most important for my role as an investment advisor and talking to high net worth individuals is that, yes, there are some people who are very savvy when it comes to all of the jargon that we share. But then there are also those people who they made their bones, who made their money in other fields. So you have to quote unquote translate it into English, something that people would actually understand so that they'll be confident in terms of where they're placing their funds. So that is on average what I have to do on a weekly basis. It's finding out what are the best investments for them, translating that to them, and then executing those transactions on their behalf.
All right, thank you. That's a wonderful insight. A lot of insights and meaningful insights from there, Sir. Thank you. How about Miss Melanie? Can you share to us your typical weekly routine?
Yes. So yeah, as an analyst, I cover a specific sector. So, for example, for me, I cover consumer gaming and related conglomerates. So basically, I'm in charge of monitoring any developments with these companies constantly. And I guess in a typical week, well, a lot of my time would go towards reading reports, meeting with other analysts to get their views on the stock, also talking to management as well, and well, right now it's one of our busier seasons, which is earnings season, and that's when we have to attend earnings briefings and to see whether companies' earnings their performance is in line, ahead, or behind our expectations, and does this change our view on the company or on the stock. So I think yeah, and apart from that, also we regularly talk to the portfolio managers as well, give updates and on our views, and if there anything material happens to the company, if that changes our view as well.
All right, thank you for that, Miss Melanie. Sir Garie.
Yeah, so for me, it's a little different in credit. So what we do in the job is basically we help smaller issuers issue bonds in the market where otherwise they wouldn't be able to. So in a typical week, I'm usually working on live deals. There's a lot of back and forth. We conduct due diligence on these issuers. We set preliminary terms or the terms of the issuance, and then we draft the proposals that we ultimately propose to our investment committee. Who decides ultimately whether or not we want to underwrite the exposure. And so that's how it happens in principle. But in reality, like I said, there's a lot of back and forth. For a single issuance, it can take about 6 months because of the negotiation process, right? So that's the bread and butter of the role. But I also work on certain monitoring work because we do have credit exposures for the clients that we helped in the past. So it's at least an annual exercise. We just want to make sure that they're compliant with their covenants. There's no deterioration in the credit. Although in the past year, because of COVID, we've had to up our monitoring. So now it usually happens like quarterly. But that's basically what happens in a typical week.
Great. So thank you, Sir Garie. All right. So before I move to my next questions to the panelists, I just want to remind the audience that if you have questions, feel free to post in our chat box. So yeah, I'll continue. So did you have any assumption on the role that you realized later on to be different in reality? So it's like, what is the difference of the actual practice and the theory from the academics? So let's say, so what are those? So Sir Ram?
Sure. I don't really consider it as a wrong assumption, but maybe I underestimated something, which is the interconnectedness of a lot of different things. By that I mean, on paper, I don't know, for those who are currently taking economics, you hear it all the time, yung ceteris paribus, right? It's like holding everything else equal. They keep saying that because honestly, it's hard to teach something without saying, okay, assuming just these things happen, then this should happen. But in reality, when one thing's happen, it really makes like a domino effect happen wherein, okay, I thought that this should happen in theory, but then there is some different factor or maybe an industry that will be affected differently with this news. I know it's speaking in broad strokes, but generally speaking, it's good to have that basis, that foundation, right? Theoretically knowing that, okay, if interest rates go up, then should bond prices go a certain way? Yeah, you should know that in theory, and usually it follows. But are there certain factors that will make one kind of bond outperform? Are all markets affected equally when, for example, inflation increases? Are there some stocks that should actually benefit from a situation like what's happening now? Those are things that I think coming out of college, I really thought that, okay, maybe if I just kind of knew all of the basics, if I just worked at it, it'll be easy. And what I realized is that, as mentioned earlier, the market's always moving and the way that things affect each other kind of surprises you sometimes. So some of the best investors are the ones that, yes, they know that in theory things should happen, but if they call it wrong, which will happen if you're a trader, you're not a trader until you call something wrong. You need to be the one that can adapt fastest if you really want to make it out.
Wonderful. Thank you, Sir. How about Miss Melanie?
Well, specific to my role, I think that I was a bit more informed than because I mean I came from the south side, so I guess I had a pretty good idea of what a buy side analyst would do. So I think not so much surprise on the technical aspects of the role. I think maybe one big differentiating factor would be that in the buy side you spend a lot more time talking to people and gathering different viewpoints. In the sell side, it's more of your kind of forming your own view and pushing that, right? And I think I guess like from a valuation perspective, since my role involves a lot valuing equities and stocks, I think that something that is not really that doesn't apply automatically in real life is that fundamentals. I mean, it's one definitely fundamentals is one thing that drives stock prices, but then there are always other factors to consider, which are hard to quantify, such as like sentiment, flows, and those are things that can, I mean, they can definitely drive the stock price movements in ways that you might not be able to expect.
Thank you, Miss Melanie. Sir Garie, you want to share?
Well, for me, like I said, I entered credit with an equities background. So I guess the most wrong assumption is I severely underestimated how much more conservative bond investors are relative to equities investors. Because as an equities analyst, when you look at the ability of a company to repay a bond, you only look at certain ratios, and then if that's fine, then you say yeah, it's fine. But when you're in credit, every single breach or well, nothing is taken lightly. Even the slightest breaches could be considered an early warning signal for a default. And which is, I think, fair because even in the past year, because of COVID, we've seen some previously strong companies that are now in trouble. So it's fair, but like I said, that's the wrong assumption. Credit in equities, the risk appetite is very different.
Thank you. So before I move on to the questions from the audience we have here now, let me ask you let me ask you this question, then I'll move on to the questions from the audience. So what factors do you usually consider in your analysis and recommendations? Maybe we can start with Miss Melanie.
Okay, so since in my role, we typically focus on fundamentals. So in valuing a stock, we look at the company's business model. Is it sound? We look at its position in the industry. How is it doing versus its competitors? And we also look at, I guess, external factors that typically affect companies and how prepared they are to weather it. So like, for example, for consumer companies, inflation would be something that would typically be a negative for these stocks. So I think like so that would comprise sort of like the fundamentals of the stock, the earnings. And after that, we also look at valuations because even though a stock, like its earnings prospects are good, if it's too expensive, then maybe it's not a worthwhile investment. So those two things, earnings and valuations, are what we usually look at.
So was there a time when your expected results did not materialize the way you expected? So how did you recover from it?
Yeah, this does happen, especially if, I mean, there are times when companies' earnings do like either they miss their expectations or they beat. What I do is basically I have to adjust and my forecasts and start to review what I missed or if there's and what was the reason behind the miss or the beat. And if this is something sustainable or something that's going to last for a while, then that would affect my view and I would communicate that either like in an investment memo or towards the PMs. So I think it's important to understand what was the reason for why it didn't meet your expectations and if this is something that will last for longer than expected.
Thank you for that, Ms. Melanie. Sir Garie.
For the credit side, since our credit exposures are held to maturity, there's no upside. So the analysis is focused entirely on the downside. So we're focusing on whether the company can repay the bond when it matures, right? So we usually look at their cash flow, the liquidity they have on their balance sheet, and we want to make sure that it's enough relative to upcoming maturities. Because a company could be solvent, but they may be illiquid. And if your credit exposure is further down the line, if they default tomorrow, you're also defaulted, right? So that's the kind of thing that we try to analyze when it comes to credit analysis. Also, we look at covenant ratios. We want to make sure that there aren't any significant movements in the ratios, in the minimum ratios that we set when we invest in the exposure. And if there is, we want to explain why. And ultimately, we want to make sure that their credit rating of the issuer is still within our expectation. So that's basically how a credit analysis is performed.
Wonderful. So same question. Was there a time when your expected result did not materialize and how did you cope with it?
As a credit analyst, no. because if I'm wrong, the company defaults, right? So thankfully, no such cases yet. But as an equities analyst, I think that could be a lot more frequent. My most memorable mistake was I rated a particular mining firm a hold. I underestimated the upside. Our clients missed out on a huge gain. I think it was 20% because I underestimated the rally in gold prices. So that was what I got wrong. How I recovered from it, I adjusted the rating. So later on, I was able to call the top of the stock. But yeah, if you're wrong, you have to adjust.
That's great. Sorry. Thank you, Sir Garie. And Sir Ram, what
Yeah,
factors in your analysis?
sure. Well, maybe before I get there, I just wanted to comment on the shift on Gary's career being really equities focused, risk taking, and then suddenly moving to credit must have been a big shift mentally. In terms of what I consider, right? I think my colleagues already mentioned some of the things that even we would consider when we're pitching to clients, things about fundamentals, economics. I mentioned earlier like the interplay of things, but I think particular to my role because I'm also client facing for the direct holders, right, the high net worth individuals. A lot of it is also considering people, and that is I think the big variable because there are a lot of people that honestly they have this idea of what they want, or they think that of course they always say na syempre I want the big return, diba? But then they kind of underestimate how risk averse they may be. They might assume that they're willing to take on certain risks for the upside, but then when they see the downside, they start to. It's okay if they just feel. It's bad if they feel sad, but it's worse if they are actually mad at you on that. So it's a lot of understanding their objectives and being able to relay that back to them. And in terms of like, were there times that maybe I may have made a recommendation, something that didn't pan out, or even before with my other hat as the actual fund manager, making the investments that didn't pan out either. There are a lot of times that happens. As I mentioned before, if you're a trader who has never lost, then I don't know if you're really a trader or how honest you are, right? Um, Hopefully you get a lot more wins than misses, and the misses are kind of small. But I think what I'm gathering from my own experience and the experience of my colleagues is that what you need to do is be able to admit to yourself that okay, there's this mistake that happened. I made the best call that I could make with the information I had on hand. I would like to think that the logic that I put into that decision was sound. Is there something that I missed, or is this like a one-off event where nobody could have seen it? And then once you analyze that and find out, okay, was this on me or was this something no one could have really thought through? That's the time that you have to tell, in my case, your clients that, okay, this happened. We did not foresee this happening. And now moving forward, I have that information on hand. So I would say that probably most of the experienced traders out there, the reason that they're good isn't just because of luck, though part of it is always going to be some luck, and it's going to be partly knowledge, and that knowledge is coming from a lot of taking bumps along the way.
Thank you, Sir Ram. That's an insightful story. So I have to move on with the questions from the audience. So this first question, this is a short question. So how many hours per week do you have to work? So feel free to answer. Sir Garie.
For me, 40 hours. I'm lucky that my employer isn't very, they aren't slave drivers. They have respect for, the work-life balance. So we don't usually get emails past 5 p.m.
Yeah, that's great.
Yeah, but
So
I guess it depends on the culture of the employer.
how about Miss Melanie?
I don't really count how many hours I work, but I think there are definitely times when I have to do overtime. But I try to manage my time accordingly. There are just times when you can't avoid it. Sometimes I get either if it's during earning season or if and there are a lot of companies reporting and you just there's just no you just have to take the responsibility and do some and put in the time.
Great. Thank you. Sir Ram?
How many hours are there in a week is the question. No. To be honest, I think people need to have that mindset that Melanie was mentioning. Sometimes you can't really count the hours. Of course, work-life balance is very important. I super advocate for that. But at the end of the day, sometimes it's about the workload that's there because sometimes you can't control it. There are weeks that are very light. There are weeks that are probably very heavy, especially when new issuances are coming out. And for a lot of people, they really should have that mindset of being output focused. At the end of the day, you could spend 8 hours a day at the office, right? And maybe your output, you're not too productive. So I would say that if you're someone who is very productive in a short amount of time, you can do those bursts, then that would be great. And maybe this role could be good for you because there are times where all you need to do is come out with a report or come out with analysis. And if it only takes you a few hours to get there in a day, then maybe you can spend the rest of the day finding something else to do with your time that will kind of balance out in the end. So maybe the short answer is that generally, yeah, the 40-hour work week is still there. There are going to be some stressful weeks and some light weeks, but you should really be focused on your output rather than the amount of time you spend.
Thank you, sir. Yeah, actually, so because have you experienced it that there were times that you spent time for this particular investment opportunity, and then after a few hours of researching about it, then you realize that it's not worth investing in it. So it's like you wasted some hours, but it's not wasting. It's part of the work of an analyst. So yeah, just want to
Agree.
share about that.
No, and to add, right, it's you're not wasting your time because you avoided wasting your money. So at the end of the day, that's also good value.
Yeah. So let me move on to the next question from the audience. So what are valuable skills or foundations that are needed to your jobs, and how did you upgrade those skills? So, Sir Garie?
Valuable skills. For me, I think just a very, very good grasp of the fundamentals. Even now, I return to, the fundamental principles behind, if I'm looking at equity, the principles behind discounted cash flow, things like that. If you're trying to understand how a certain piece of information might affect a stock, and if you're lost, you can just go to the formula for DCF and see how it might be able to affect the stock. So everything that you do as a financial professional goes back to the fundamentals. If you're hazy on that, you're gonna have a hard time.
Thank you, Sir Garie. Ms. Melanie, do you want to add?
Yeah, I agree with Gary on the fundamentals, especially understanding financial statements and understanding how like certain events or affect the certain ratios or certain affect certain ratios of a company. I also think communication is very important. You could have the best research, like you ran through all the numbers, but if no one is convinced in to buy or to sell, then basically it's not worth anything. So I think those two are the most important. In terms of upgrading, well, apart from getting my degree in UP, also doing CFA, that was really helpful for me.
Thank you, Ms. Melanie. Do you want to add something, Sir Ram?
I think just to add, maybe it was mentioned also briefly by Melanie earlier, is that you have to be pretty curious to be in this field because there's so much information coming in. So if you're not someone that is ready to get bombarded with more info on a daily basis, then it's going to be hard for you to really thrive. So definitely agree with my co-panelists here, where you need to have a good grasp of the fundamentals. So when the news comes in, you'll be able to process that better. And in terms of upgrading or upskilling yourself, yes, your college degree gets you a little far. The CFA charter really helps in terms of really making sure you have a good grasp of the fundamentals. But I wouldn't sleep on some of the free resources out there. There are a lot of places where you can get some information that you can check out, especially we have a lot of young people here. If you want to like dip your toes into the water, there are a lot of resources that you can use out there that might help you get started, so that when you formally start working for a place, hopefully, if they can cover your your CFA charter, the exams, then that would be great.
Yeah, actually, pursuing a CFA, I believe also is worth it. And my first employer luckily paid for the fees of my first two exams. So yeah, maybe when you guys from the audience, when you work in your first job or after your school, you can ask your HR or your bosses if they'll shoulder the exam. And I think it's really worth it. Or all the learnings from the CFA curriculum and the exams. And another question here, is it toxic or what is the culture or environment in research investment analyst work? So is it toxic? How is it compared to the other roles that you have tried? So the virtual floor is open. You can answer.
Maybe I can start because I am thankful that in my career before, as someone on the buy side, as a fund manager, I'm the beneficiary of people like my co-panelists where maybe I'm the toxic person in the formula here. But we would normally ask our different brokers, like, can you give us information on something in addition to our own research? So I don't know if there are a lot of, I guess it's with most things on a case-to-case basis, maybe some institutions are a little bit more toxic than others, but at least my experience on the buy side as a fund manager and now investment analyst, it's a lot. I would say working with the industry people has been it's a light feeling. I have a lot of friends in industry, even if they're my competitors. I feel like I can grab a beer with them as compared to maybe some other places where you don't talk to your competitors at all. And in terms of toxicity, I don't feel that. But of course, there's going to be every now and then, maybe there's some random person in the office or one bad client that might ruin your day. But in general, I would like to think that it's a pretty good environment to be in.
Thank you, sir. Thank you for that. Do you want to add, Sir Garie?
Uh, for me, not so toxic. I guess for local firms, local brokerages or local banks, it's quite chill. Not in the sense that they're lazy, but when you're not working on anything, okay lang magchikahan. But in settings such as foreign, for example, like where I work now, it's multicultural. It's not toxic, but you certainly see more people that are more high strung, more workaholic. So I guess that would be the difference. But overall, I would say not toxic at all.
Thank you, Miss Melanie.
I think that, well, I mean, I have the only roles I've ever taken on are analyst, but one on the sell side and one on the buy side. But I think that in general, in the different companies that I've worked in, there's a high level of responsibility. Since you are in charge of handling the sector, you're supposed to be like the expert, right? So I think there's some kind of pressure and high expectation there. And I wouldn't say that it's toxic. I think it's just a different kind of culture. I mean, it's not unheard of to work overtime to publish a report in the sell side. And now that I'm in the buy side, after a briefing, I get lots of reports until 10 p.m. and I think it's just it's not. I think it's just the nature of the job. You're supposed to be the expert, and the market moves fast. So if you're the last to publish, then you're not delivering value to your client, right? So I think it's just the nature of the job.
And to add to that one, I think I agree with Sir that it's basically an output-based work also. So depending on your output, if you can produce that with minimal time, then that's great. And yeah, and the environment, it's not that too stressful or difficult. So yeah, thank you for that. And I think this next question is particularly interesting. In doing a research analysis, there are too much information out there. How do you filter out those information? So sometimes we are bombarded with too much information, especially after the COVID pandemic. There are a lot of news, there are a lot of issues. So yeah, how do you filter out those information? Yeah, feel free to answer.
I guess for me, just as an equity analyst, like I said, I always go if I'm confused, especially when I was starting out. Whenever I get confused, I just go back to the TCF formula. So if I hear a certain piece of news, how would this affect the formula? Where in the equation would this fall? And once you figure that out, okay, so what's gonna happen to the valuation? So I guess the way to distill information would, like I said, just go back to the fundamentals. How would it affect the theoretical value of a company?
Yeah, that's a wonderful answer, to be honest, Sir Garie. I think, yeah, you just need to assess, right, if it's relevant to your analysis or to your work. So yeah, that's a wonderful insight. How about the others? Do you want to add something?
Sorry, Melanie, do you want to go?
Sure. Okay. So yeah, for me, I think it's important to focus to know and understand what are the biggest things that affect your company, right? And to have a good understanding of what are the major drivers of that company's earnings. So like for example, if when you look at a company, how many percent of its revenues stem from a certain segment, or um, like maybe you can even look historically, like how has the company like adapted to certain external factors in the past. I think knowing what are the major drivers is key to so that you'll be able to focus on what's important.
Thank you, Miss Melanie. Sir Ram.
Yeah, maybe just tying those together, because I think those are really the answers, right? If you have a good grasp of the fundamentals, it's key. The way that I personally do it is that I try to put myself in the shoes of management. Like, I would like to think that, okay, if I research on the company well enough, and as mentioned by Melly, I know that the business lines are, when news comes out, I want to think, okay, how does this affect my business, assuming that I ran it? Putting myself in those shoes kind of makes me feel like I have a bit more control. It makes me feel like, okay, I would have a better understanding of this, because if I were running this business, do I think it's going to be impactful, or do I think that's going to be something that won't make too much of a difference? So there's a lot of news out there that when it comes out, it might affect some industries a lot more than others. So putting yourself in the mindset of being the owner of that business or someone in that industry kind of helps you understand whether or not the news is news to you or noise to you, which is sometimes you could have one piece of news, but then different perspectives will give you an idea of whether or not it's really valuable.
Thank you. Thank you for that, Sir Ram. So yeah, I think last question from the audience. I'll just read here. What would be your recommend? Sorry. Uh, what level of Microsoft Excel skill is needed for your jobs?
A high level, a very high level. Well, honestly, I don't know. When I started, I didn't have a lot, but then over time, you're gonna be forced to learn those skills. Like I learned how to do some form of like macros just because I couldn't. Again, talking about efficiency, right, and about hours in the day. If I don't feel like I have enough hours in the day, I have to automate some things. So I had to force myself to learn what certain formulas could help me speed things up. What are my daily tasks that I need to use? Again, like macros or VBA, just so that I can speed things along. You can definitely, you're welcome to start your career without having a high level, but to be really efficient and make it up the ladder, you're probably going to need to improve that, because the faster you can do things on Excel, the faster you can generate your reports, the faster you can give your analysis, the faster you can move in general. And I think that's honestly something that's not just for finance professionals. I think even for other roles, if you're good at Excel, if you can automate that part, there's a lot that you can kind of take away from your time in terms of working on administrative stuff, and gives you a lot more time to do some deeper level thinking on things that might pop up.
Thank you, Sir Ram. Miss Melanie.
Yeah, I agree with Ram. I think that well, at least when I was in college, Excel was kind of on the back burner. It wasn't really something focused on. And then suddenly, when you get to your job, you're expected to build a financial model and all these things. I think it's something you learn eventually, and as long as you know the fundamentals, it's quite easy to pick up. I think something else that could be useful as well is some familiarity with Bloomberg terminal, as that's a really useful information source, something we use almost on a daily basis as well to get information.
Thank you. Uh, yeah. So I think, yeah, thank you for that. And I'm very sorry we cannot accommodate any more some few questions since we're running out of time and we need to wrap up the discussion. So for the panelists, any final advice to our viewers or to our audience? Maybe we could start with Sir Garie.
Final advice, I say don't rationalize wrong calls. As an analyst, you have to learn. You could stand to learn the lesson that you don't know anything really. You could always be wrong, and if you're wrong, you have to be able to adjust. You can't hang on to wrong calls. So that's, I guess, the most valuable piece of advice that I've learned over the years.
Yeah, thank you for that, Sir Garie. Miss Melanie.
Yeah, similar to Gary, I think being humble is something that if the market can when it moves in a certain direction, it can definitely humble you when you are wrong. That's something you need to remember. And I think also another one is to stay hungry. The You need to have this ambition, this drive to be able to continue to do well in this industry.
Thank you. Thank you, Miss Melanie. And Sir Ram.
I think to add to that, it's staying curious as well. So they all make sense, right? If you're hungry, you're gonna need to be curious. If you want to be humble, it's seeking out the information that you did not know before and now you feel like there's a gap. If you're going to make it far in this industry, a lot of it has to be understanding that you need to continue your education, that whatever you know now is not enough. And the more you know, the more you realize you don't know that much. So over time, that's going to really humble you and it's going to make you. The thing is that when you talk to clients at the end of the day, or you talk to your friends, your family, you're going to be more knowledgeable. But it's also that understanding that, hey, maybe I'm wrong. Maybe something I said could have been wrong. And it's knowing that I need to seek out that information as times change because the answer might change as well.
All right, thank you, Sir Ram. And thank you also to our viewers for listening and sharing your questions and your thoughts with us. So I hope you enjoy our next segment of this event. And I really know you'll learn a lot from this event. And I'm excited for you and for your careers as well. So thank you. And I'll giving back the virtual floor to Miguel. Thank you.
Thank you so much, Melanie, Gary, and Ram, and of course Juno for moderating. When I was listening to the entire thing, the first thing I thought was sana all. Really, the insights and the experiences. Sana all is definitely fitting. As a token of appreciation to the four of you, we'd like to present to you the e-certificate. So let me just read the certificate citation. We present the following certificate of recognition to Ms. Melanie Ong, Mr. Ram Cervantes, Mr. Garie Ouano, Mr. Juno Fragante for being speakers and moderators respectively for the Research Analyst Career Track and the Philippine Junior Finance and Investment Summit 2021. The future starts now. So if it's okay with you guys, as a custom, if we could have a quick photo op. And just sincere thank you again for your time and effort today. So Precious, will you be the one taking the photo?
We're good.
Thank you so much again. So our sincere appreciation for your time and effort for being here. Melanie, Juno, Garie, and Ram. To our audience, we're going to have a 10-minute break, so hope you get to digest all of that. If you haven't downloaded the CFA Society Philippines mobile application, please do so now. And then for your questions, please see the prepared list of frequently asked questions available also in the app. And again, our official hashtags, if you want to post about PJFIS 2021, the future starts now. So it's hashtag PJFIS 2021, hashtag the future starts now, and the hashtag CFA Society Philippines on Facebook, Instagram, LinkedIn, and TikTok if you have. And please don't forget about the evaluation form that you need to answer on each day of the summit. This is part of the requirement to get the e-certificate. And then please attend 70% of the whole summit, or at least 13 sessions to get your e-certificate. So that's that. And we'll see you back here in around 10 minutes for the second session of today's breakout. Thank you again to our speakers.
Thank you.
Thank you.
Thank you.
Take care.
Why choose the CFA?
How's being a charter holder helped my career?
The confidence that it's given me in my own analytical ability.
Being a charter holder has broadened my perspective.
My understanding of the industry is much better than before.
You gain a broad understanding of a lot of different subjects.
And it's made me more confident in the work I do.
Instant credibility from my peers.
I can go to a different country. I will meet people who have the same qualification, who understand what I've done to achieve it.
It's a global program, so you can speak to someone who's a charter holder from India or from South Africa, and they understand you.
It feels good to know that it's quite valuable for employers in the industry.
My belief that I can achieve anything.
So I think being a CFA charter holder helps me to communicate with my clients in a language they understand.
The CFA gave me a lot of information that I had not learned during my economics degree.
The amount of knowledge which you get is so diverse.
Something I didn't know when I started the program was how important the ethics portion was. I realize now that it really sets the standard in the industry in terms of practices.
I can speak the same language with hundreds of thousands of investment professionals.
A deep knowledge, understanding of the financial market.
It is wanting to know how all the pieces fit together.
Because it really does open a lot of doors within the financial industry.
I learned to be patient, focused, dedicated.
So when you get those letters after your name, it's a pretty good feeling.
Having the CFA on my name card gave me a huge advantage, especially as a woman, because when I walk into the room, he immediately knows you mean business.
It's not an easy process,
but nothing's impossible.
It was a lot of sacrifice, but it's worth it.
I felt that I did a very, very big achievement.
And made me feel proud.
I'm very, very, very proud.
I'm very proud of the achievement.
I'm very proud to be a CFA charter holder.
Let's build a better world for investing.
Let's lead in improving the quality and standards of the financial profession.
Keep your abreast of financial innovations here and abroad.
Be known for our integrity and professional excellence.
Let's always put investors' needs above our own.
Push for financial literacy.
Provide service to the investors through the selection of the best managed funds of the year. Let's build trust in our industry.
Advocate on behalf of industry issues.
Convince trust and asset management companies to adopt the Asset Managers Code and the Global Investment Performance Standards.
Let's put ethics at the heart of everything we do.
Talk about ethical decision making.
Encourage ethical behavior and be really passionate about it.
Create an environment where investors' interests come first.
Markets function at their best and economies grow.
For the ultimate benefit of the Philippine society.
I am Chris Arceo.
Mark Yu.
Erwin Ocampo Avante.
Rob Brown.
Sandra Aurelio Gonzalez.
Mark Ilaw.
Kate Burgos, and I am CFA Charter.
We measured
up. Join us.
Let's measure up.
Okay, everyone, welcome back. Good afternoon, and I hope you all kind of recovered already from all the insights that you got from the first session with Melanie, Juno, Ram, and Garie. I hope you got those insights on how to be an investment analyst or research analyst. Before we proceed, I just wanted to, on behalf of CFA Society Philippines, thank our sponsors, event partners, and media partners. So our platinum sponsors, MSCI Philippines. Our gold sponsor is AP Securities Incorporated and Call Financial Group. Our silver sponsors are Atram Trust Corporation, DBP Daiwa, Capital Markets, Papa Securities. We also have our media partners, Business World, Publishing, and Business Mirror, and our event partners, the Bureau of the Treasury, the Philippine Stock Exchange, Inc., and the Securities and Exchange Commission. So thank you to all of them for helping make this event possible. So on to our last session for today, and it's a deeper dive into investment research, investment analysis. When research analysts assess firms and securities in the market, they generally use two main approaches. You have top-down or bottom-up. In the next session, entitled Top-Down or Bottom-Up Analysis, when and where to use, our next speaker, Dr. Joel Litman, will share with us the difference between the two approaches and discuss when each approach should be employed. Dr. Joel is the president and CEO of Valence Research, a global investment and research and advisory firm, and the world leader in uniform accounting and analytics. He's also the chief investment strategist of Altimetry Financial Research, a boutique financial research and publishing firm providing individual investors and families with unique, unbiased investment recommendations and strategies. In the Harvard Business Review, Dr. Litman published Give My Regrets to Wall Street and is a top contributor in the platform Seeking Alpha. Valence Research reports are regularly the most downloaded on FactSet. He has been interviewed on CNBC, Forbes, the Singapore Stock Exchange, the Wall Street Journal's Barron's Magazine, Institutional Investor, and NASDAQ's market site. He has also conducted seminars and lectures for Harvard Business School, Wharton, London Business School, and other universities and CFA societies in New York, Germany, Hong Kong, Singapore, Japan, and more around the world. Moreover, he is part of the faculty as professor at 3 universities. Dr. Joe is a CPA and an MBA MM graduate from the Kellogg Graduate School of Management at Northwestern University. So let's all give a virtual round of applause for Dr. Joel Litman.
Thank you.
And moderating today's Q&A session, let's all give a virtual round of applause, please, to Mr. Riche Lim, CFA, co-founder and chief product officer at Erudifi, an edtech startup. So the floor is yours. Rich, I'll pass it over to you for the moderating. Oh, sorry, Dr. Joel first, I think.
No, I'm happy to. Thank you. Let me share my screen. So I was asked to speak about bottom-up and top-down analysis. And, invariably that means talking about bull and bear markets. So where did bull and bear market get their names? If you look at Investopedia and you study, I don't know, a couple hundred websites, they're going to tell you, many of them, unfortunately, say that, well, it came from this idea that bulls swipe up and bears swipe down. And this is a nice fantasy, but it's nonsense. It's BS. I can't believe Investopedia even mentions it, right? This is ridiculous. The idea that that bear and bull markets are because of a bull and a bear fighting is just silly. I'm going to show you where it comes from. And it comes from originally an understanding bull and bear markets and therefore understanding how top-down analysis is done. All right, this is silly. Is who's keeping tally? Who's keeping score? So for the last couple thousand years, tally sticks have been used. What they found was that if you split a piece of wood prior to 3D printing, it's impossible to counterfeit. It is impossible to recreate 2 pieces of wood split that fit together perfectly because of the grains of wood. It was genius. And this is around the world, right, that they discovered this idea. The long end of the stick meant you owed Someone owed you money. You had equity, you had whatever. So you loaned someone 20 cows, they now owe you 20 cows. You gave them, 50 chickens, they owe you chickens, or, pounds or silver, whatever else. So these tally stick securities, if you had the long end of the stick, right, you were owed money. That means people have to give you something in the future. If you got the short end of the stick, and yes, that's where that idiom comes from, you get the short end of the stick, that means you have to pay someone. You owe somebody. You're going to have to give them something in the future, and the value could go up over time. The short end of the stick was also nicknamed the foil. So that never stuck. I don't know that foil stuck, but you know what the long end of the stick was called? They called it the stock. This goes back, I don't know how long. So the stock and the stock market is based on people owning the long end of the stick of a company. Hey, I gave you money, company. Now you better give me profits in return. You better give me dividends in return. So you want to be long the stock in a bull market when things are going up, and you would want to be short when things are selling in a bear market. And you say, now, where did the terms bull and bear market come from? Well, bear market, I'm going to start with, because that's from like 400 plus years ago, not from bulls and bears fighting. But basically, I don't know if anyone likes this actor, Leonardo DiCaprio, Leo DiCaprio. And this is from the movie The Revenant, which won all kinds of crazy Academy Awards and everything else, because it was just an amazing movie. And in that movie, he was a bearskin jobber. He killed bear because bear had wonderful furs that people demanded. And it's funny because bearskin jobbers were notorious for selling bearskin short. They would sell bearskin short. So going back, I mean, this is when you can find printed work, which means it was going on for a long time before then. So in the early 1700s, they said, if you're selling, right, you're ensuring real value on an imaginary thing, you're selling a bear, meaning, hey, this thing is really worth something and you're selling it, but you're hoping the value will fall. And that's what bearskin jobbers were doing. And people didn't like bearskin jobbers, just like GameStop. Like everyone's celebrating, oh, those people that were short on GameStop, the stock, right? And said, oh, and you're short on movie theaters. This is terrible. I like movie theaters. I like gaming. And so anyone that's short those companies is bad. They're the devil. They have a cloven foot. They're a false friend. We don't like people who short stocks, apparently. This has been going on for 400 years. This is not new, right? Which is with GameStop, that we don't like short sellers. Like, why should someone make money when a company does poorly, when a company does badly? That doesn't seem right. We should only make money when things go up. Well, fortunately, there is a market for shorting, and where the term comes from, and bears and selling bears in bear market comes from these bearskin jobbers, right? That's the bear market. Now, I want to talk about the South Sea, because this was the crypto of the day. This is a piece of stock in the South Sea Company. And the South Sea Company was unique. Again, I'm going back several hundred years, right? It was unique because they were given a monopoly for all trade from basically Britain to South America. All of South America, if you wanted to trade, you had to go through this company. So they said, well, this has got to be incredibly valuable, right? Anything I'd ever want to buy from South America, I have to pay this monopoly South Sea. So the stock was going up a lot because of it. And it was going up like crazy, right? This is 1719, 1720. Stock keeps going up. And guess what? It goes up even further. It's astronomical. It looks like crypto, looks like Bitcoin, looks like the dot-com bubble in the late 90s, right? Now, Alexander Pope, the number 2 most quoted poet after Shakespeare, right, starts writing about it. It's no different than people writing about Bitcoin, singing about Bitcoin or singing about crypto and hip hop or whatever else, because people are making all this money. Well, that's the equivalent, except there was no music, hip hop music back then. So what do we have? We had poetry. And so he says, come fill the South Sea goblet full, meaning I have this South Sea stock. Give me more. Please give me more. Make my goblet full. This is poetry, right? And then he starts praying. Anybody ever pray for a stock to go up? Anybody pray for the PSEI to recover, right? Are humans that different from several hundred years ago? The gods, please take care of my stock. Make it go up, right? This is not that different. And he's praying about a stock, the South Sea stock. And then he says, Europa, that is a goddess, right, from mythology, accept the bull. Give me the bull. They're talking about the bull market. Let the stock keep going up. That's the bull. and Jove, right? And by the way, the bull, this concept of bull is not 400 years old, right? The bull shows up on money going back 3,000, 2,000 years. This is not new, right? So the idea that bull swiping up is no, bull market has been associated with prosperity. Bulls are associated with prosperity going back thousands and thousands of years. In fact, the original money in some parts of the world was actually a cow. The money, they didn't have coins, right? They didn't have paper money, so they traded in cow. How much cow is that? Well, I've got 50 bushels of hay. Well, how much is that? It's about 3 cows worth. They were talking about cows as money. So the idea that bull is prosperity has been around, and they're hoping the South Sea bubble, the bull, will continue in the South Sea Company, right? And Jove, Jupiter, please keep the bear away. Put off the bear. Don't let the bear market come. So this bull and bear concept's been around for hundreds of years, and the idea of a bull market being prosperous is thousands of years old, right? Unfortunately, it didn't happen. Stock collapsed. Now the stock was still worth something at the end because they did have the monopoly, but nowhere near as much as people had thought, right? A lot of people lost a lot of money in it until it settled down to some fundamental level of value. But the reason I'm bringing this up is that's where we get the bull idea. Bull and bear markets. You want to be long in a bull market and short in a bear market. This is the idea of big top-down macro analysis. Am I even in the market at all? Should I even be right in the right place at the right time? And someone very, very smart, very wealthy investor was looking at the stock market and said, you know what I've noticed? There's nothing new on Wall Street, right? It's not just money that's thousands. The entire stock market, right, doesn't seem to have anything new. It just repeats itself over and over again. Not necessarily in a day or a week, but it does repeat over years. And he says there can't be anything new on Wall Street because of humans, because of speculation, because of essentially people betting in the market. He said, whatever happens in the market has happened before, and it's going to happen again. Right now, that genius person that said this, one of the greatest investors ever, right, actually said this looking at this chart. He was looking at this chart in 2004. He said, look at the stock market going up. And he noticed there's really good credit. Listen to this. He said, there's really good credit. That's why the stock market would go up. This is what this genius said. And he said, and as long as I keep seeing really good, ample credit, banks loaning money, easy to get money from investors, just financing anywhere you look, he said, it's going to do even better in 2005. And it did. And he said, this is going to continue until even 2006, where he said, wait a second now. Suddenly, I see banks aren't loaning people money. In fact, they're calling it in. They're canceling their loans. Even if you go and you say, hey, can I get $1 million? They'd say to you, yeah, do you have $1 million in the bank? Like, if I had $1 million, why would I need the loan for $1 million? This a lot of developed markets, that's still the case in many banks. It's hard to get financing. Then it holds back stock markets. Then he said, all right, then it crashes because there's this huge credit crisis, massive credit crisis in 2006 and 2007, and then it comes rebounding back, right? That's the pattern. All right, now I'm actually going to show you the newspaper headlines, which should be a clue. I'm going to show you the newspaper headlines, actual newspaper headlines during this time period. In June of 2007, New York's bond offering fails. Even New York can't get any debt. October 2007, financial contagion spreads. Interest rates soaring. Sound familiar? November 2007, major brokerage nearly collapses. Now I'm wondering, Richie, I don't think you were, you might have seen this. No, you weren't here then. You weren't around to see this market in 2007. You're like, well, wait a second. This was only 10 years ago. And maybe there's some faculty on the call that say, wait, I was around in 2007. No, you weren't. What? Why weren't you around? Well, anyway, banks and business in bankruptcy, November 2007. This is common. These are the newspaper headlines. And then bailout. And with the bailout came the rebound in the market. Right. Now I've probably fooled you all. How have I fooled you? This super great investor wrote that thing about Wall Street in 1924. 1924. His name was Jesse Livermore. And when he wrote it, he was looking at the market panic in 1907, not 2007, 1907. And those headlines I just showed you, I didn't say internet headlines. I said newspaper headlines, were actual headlines in newspapers. And I'll bet you anybody on this call said, oh, that looks like the Great Recession, 07, 08. Nah, guess what? 101 years earlier, almost the exact same pattern happened. right? Those headlines were from actual newspapers, brokerages collapsing, right? Banks and businesses in bankruptcy, and of course, bailout. If you don't have the bailout, you don't have the rebound. It takes a long, long time for a rebound in the market if you don't have a bailout. And so that's why you see that bear market rally, because there was a bailout at the time in 1908. Now, don't blink. All right, I'm going to show you another pattern. You see that? That's 1974. That's stagflation, horrible inflation. All right, let me go back. 1907. Could you tell the difference between these charts if I didn't show this? All right, to be a great equity investor is what we learned. You have to be a solid credit analyst. That is the core of top-down equity investing. If you don't understand where we are on the credit markets, you won't understand where we are on a bull and bear cycle, because really, really great, solid credit markets lead to the support of a great bull market in equities. All right, and that is what people discovered hundreds of years ago, more than 100 years ago, that you need that for the market to be healthy. So it was 1924 that Jesse Livermore said this. It was in a book called Reminiscence of a Stock Operator. Any traders on the call will know this book, because this is one of the core books read by traders around the world, because Jesse Livermore was a trader. It was written by Edwin Lefevre about Jesse Livermore. And Livermore was looking at this. So 1924, the book was written, and it was around this time where the stock market, not 1907, but 1924, was going to the roaring 20s. And he said, you know what? There's really good credit. It's so easy to get financing. Guess what? Stock market goes up. And he says, it's continuing in 26 and 27. Prices were getting expensive. PE multiples were hitting 30, 40, 50 times. It didn't matter, because you had super financing going in. Even 1928, when some of the valuations were hitting 70 times PE, stock market's still going up, right? The market doesn't fall because valuations get expensive. The market does not fall because valuations get expensive. The market falls when you have very expensive valuations and you have a credit crisis, And that's what happened. There's a credit crisis in 1929. The banks stopped lending. It's just like 1907, just like 2008, the Great Recession. Suddenly, nobody could get debt. Nobody could get financing. Some banks were on the verge of collapsing. Stock market did its double top, and then boom. And Jesse Livermore saw this, and during this period made, let's see, how much did Jesse Livermore make? He made 100 million US dollars. Like he made like $1 to $2 billion in today's dollars. But back then it was $100 million. This is not a firm. This is a person. A person, right, made this money because he understood the impact of credit on equity markets. That is the core of top-down analysis for any stock market investor. Anyone starts looking at the stock market and top-down and just says, I'm looking at overall market PEs, meaningless. Meaningless if you don't understand where we are on the credit cycle, right? So here's the Dow. Here's the full picture of the Dow from 1917 all the way to 1941. And you see this bull and bear cycle. Now I'm going to show you something else. Take a look at that chart. That's the NASDAQ peaking in 2000. That's the tech bubble. That's .com. Now let me put these on top of each other. Whoa, looks like the same chart. Now let me literally put them on top of each other. How would you know which was which if I didn't give you the dates? How could you possibly? It looks like the exact same pattern. And guess what both patterns have? Massive amounts of easy financing, easy credit pushing into the top of the market, and a credit crisis crushing the market. In 2000, 2001, 2002, there was a massive credit crisis, massive financing crisis. Very, very, very difficult to get credit, just like what happened in 2008, all right, 2009, which is what leads to these bull and bear markets. By the way, not once have I showed you a credit chart, right? All I've mentioned is, because they didn't have credit charts back then, right, in 1907. They didn't have credit default swaps. They didn't have CDS indexes. What they had was people like Jesse Livermore going from bank to bank saying, hey, loan me money. Oh, sure, here it is. Okay, great. This must be a good market. Hey, loan me $1 million to buy some stock. Great. We'll loan you on margin. Here it is, right? It wasn't until he went to a bank and said, loan me $1 million. They're like, nope, sorry. We're not loaning it. In fact, we loan you money before, we want that money back. And you go, oh, that's a credit crisis. That's a credit crisis. So let's see. There's the Dow. And what is below there? The FXI. Anybody know what the FXI is? The FXI is an ETF for China, peaking in 2008. Almost exactly with the peak of the Olympics on 888, the Beijing Olympics, right? Where the whole world is focused and created all the hype. And then you had credit issues come in and the Chinese stock market has fallen and really hasn't recovered to those prior peaks since. And then here we have a little market. We could see sort of this, but really, really good credit going in. We see this bear market around the back end. Let's see, what years are this? 89. So that 97, 98, it's the Asia financial crisis. Now, this isn't that liquid a market, so you don't get as pronounced highs or as pronounced lows, but this is the PSEI. This is the PSEI, the PSE composite. It's a Philippine stock market. So this works everywhere. The more liquid the market, the more pronounced the spikes and the drops. The less liquid the market, the more it rolls a little bit. Right. So this is the market phase cycle. You have a value stage. You have a growth stage where valuations get crazy and every value investor says, oh, the market's expensive. It's about to collapse. Well, they've been saying that for the last 5-6 years. Even during the pandemic, they're saying the market's going to collapse, right? Yes, it did briefly. And man, did it come back, steaming. There's a market top. There's always a double top. Capitulation. Everybody gives up and back in a bear rally, right? And certain things happen to follow this, such as bull cycles always last longer than bear cycles. All right. There is a credit cycle, which is all important to understanding this. And of course, there's an earnings cycle. And to understand earnings is where we have to switch from thinking top down and thinking bottom up, because you can't do earnings analysis for a market if you can't do bottoms up analysis. You can't, right? You're saying, well, what if I look at the earnings for the whole S&P? What if I look at earnings for all Philippine companies, all Chinese companies, right? All Indian companies? Whatever. Well, if we're doing that, how do you calculate the earnings? All right. Are you just using the GAAP numbers, the PFRS numbers, IFRS numbers? If you are, you're wrong. I'm sorry. I'm a CPA, but it's too bad that my profession does not know how to calculate earnings correctly, because we don't as CPAs. We know how to account. We know how to, thank goodness the accountants are around, because the accountants produce these 200-300 page financial statements with lots of data for the finance people to use. But the earnings number that the accounts calculate is a ridiculous number, right? And the fact that all these Wall Street shops are saying, oh, let's follow earnings is just silly. So I'm switching to bottoms up. This analysis, this earnings analysis for markets or individual companies doesn't work if you're using GAAP or IFRS-based metrics. It does not work. Who says, me? Am I the one saying that? No. Someone smarter than me. Let's see. These guys say it. You're like, who are these guys? This is the greatest class reunion in history. This is a class reunion. All these students are getting together to celebrate their teacher who helped make many of them billionaires with a B. They weren't billionaires when they started learning from this teacher. They took the teacher's class, studied with the teacher, worked with them, and then many of them became billionaires or 100 millionaires. I'm not kidding. It was the greatest class reunion ever. And their teacher was a guy named Ben Graham. Ben Graham, who started the CFA Society globally with a bunch of other people. He started it. He said, we need a finance designation. There isn't one now. He also wrote The Intelligent Investor, by far the best book on investing ever written. So says Warren Buffett. All right. Let's see what else. Security Analysis, maybe the second best book on investing ever written. Pretty good. All right. Ben Graham taught this class called Security Analysis that these students took. And he created the CFA proposal and started CFA Society of New York, which at the time they called the New York Society of Securities Analysts, but today is called CFA New York. All right. And he wrote those books. Here's number one student. Who's his number one student? Of course, it was Warren Buffett, who's worth more than 80 billion. This slide is a little old. Depending on the day, he's worth now 100 billion or something, right? And he produced alpha. That's what every investor's after. Alpha is what? It's the amount you beat the market. If Buffett only did a 9.8% return, we'd say, oh, so-so. You met the market. You wasted your time. No, he beat the market by about 11% compounded, 12% year after year for 55 years, right? And still does. Amazing returns. Who did he study under? Ben Graham. Here's Charlie Munger. Charlie Munger is Warren Buffett's partner at Berkshire Hathaway, but people don't realize that Munger also had his own fund called the Munger Partnership. and his returns were better than Buffett's. He did 20% compounded return when the market did 5%. That's called alpha, the difference. He did better than Buffett. And then he joined Buffett, and now they're like this force to be reckoned with. Knapp and Anderson, you're not going to know these names, but they started a little firm called Tweedy Brown in 1968. How did that firm do? Let's see. The market did 7%. They did 20%. 20% return when the market was doing 7%. That's called alpha, right? So we want to study these people. I could keep going. Walter Schloss. Is this one picture? It's just one picture, for goodness sake, right? That's his performance versus the S&P. He did 700% of what the S&P did up until this 45 years of beating the market, right? And Bill Ruane also crushing the market, right? Since 1970. So clearly we got to study what they say. And what do they say when we look at earnings cycle? Let's see, because we can read the books that they were studying. And the term earning power shows up over 100 times. Earning power shows up over 100 times in these books. So it must be earning power is important to analyzing securities. Ben Graham also wrote another book that I don't know why nobody reads it. I think it's one of the best. It's called The Interpretation of Financial Statements. It says, if you want to understand earning power, which, by the way, I mentioned over 100 times in my other 2 books, which are the best books on investing ever written, you better study how to interpret financials. And in this book, he makes a little comment. He says, oh, by the way, net earnings, that earnings number the accountants calculate, it's often too high or too low from reality, and you probably have to adjust them. Net earnings may readily, meaning frequently, quite often, does not match actual earnings if we calculate it correctly. He says the accountants aren't doing their job on the earnings part. The accountants do their job in the accounting. Here are all the numbers across 300 pages. Here's all the notes and disclosures. That is incredibly important and necessary to us. So don't think I'm just slamming my profession. The CPAs do a very, very good job, but they don't know anything about investing. Right? Generally speaking, you don't go to say, hey, I got to learn how to pick stocks. Let's get an accountant. Nobody says that, right? Because they don't even know how to calculate earnings correctly. They know how to account. Their earnings numbers wrong. And how do we know? Let's see. This is one of the biggest mistakes of Wall Street. Wall Street is so beholden to as reported earnings and EPS and net income and earnings estimates that they are flaunting. It is the opposite of what the greatest investors in the world have said, including Ben Graham. Generally accepted accounting principles do not work. By the way, neither does IFRS or PFRS. Anyway, I'm saying PFRS earnings. It's great we have PRS financial statements, PFRS, right, or IFRS, because we need all that data to properly calculate earnings. We couldn't do it without all the accountants' work. The problem is the number the accountants come up with. Let's see, what does Warren Buffett say about this? In 2018, he says it in the first 10 minutes. The net earnings figure, it doesn't represent what's going on in a business at all. And he says that he said it at minute 7 of the 3-4 hour giant annual shareholder meeting that 40,000 people fly to Omaha to go and see. He said it doesn't represent what's going on in the business. Net earnings. That means, by the way, a price to earnings multiple is nonsense. If the earnings number is nonsense, then the PE is nonsense. So, please in the Q&A don't say, hey, I really like the stock as a PE of 15. I'm like, based on what E? PFRS. Well, then I have no idea if that's correct or not. It's meaningless, right? So would say Buffett and Munger. Let's see. In 2019, Buffett repeated it in the first 10 minutes. GAAP rules are distorted. I'm warning you. The bottom line is capricious. Capricious means moody. It just goes up and down, having nothing to do with reality. It's capricious. Sompongin talaga. Sompongin talaga. Richie, do you know I'm Filipino? I think people don't know that I'm Filipino. Some people do. I'm half Filipino. At least I'm Filipino enough to say sompongin talaga when you're talking about earnings, right? It's really a shame not everybody studied accounting, right? Not enough to realize. And by the way, do you know he repeated it again this year? Again. So anyway, Buffett's buying Amazon. And people are like, he's lost his mind. Why is Buffett buying Amazon stock? Amazon doesn't make money. Obviously, Investopedia told me so. Be careful for Investopedia. It sounds like an encyclopedia of investing, but there's so much opinion in Investopedia. You have to say, is this opinion or is this like a definition, right? Be careful of Investopedia and a lot of these websites that claim to. Anyway, they said Amazon doesn't make money. All right. Here's International Business Times. Amazon, 20 years, they don't make money and no one cares. Really? You think Buffett doesn't care if this company doesn't make money and he's buying the stock. Amazon era, no profits, no problem. Well, here's the problem. All these authors are focused on GAAP accounting, and it's true, right? If you look at GAAP accounting, you say the stock has gone up so much. That's a stock beating the market by 300%. It's 3 times the market. It's 200% beating the market, 3 times the market. And here's the return on assets, even with some adjustments according to FactSet and Bloomberg and Yahoo Finance. It's a bad company, not even earning its cost of capital, 8%, 6% return, by 2011 falling all the way down to 2. All right. That looks like a bad business. What does it look like if we use uniform accounting? And by uniform accounting, I mean what Buffett and everyone says, adjust the accounting. Let's see. Literally off the charts. Amazon had years where they made 130% return. That means for every $1 billion in assets, they had pure profit of $1.30 billion. Unbelievable. So no wonder Buffett's buying Amazon, because he's not looking at the nonsense GAAP numbers. He told everyone that. He always says it. I don't look at the GAAP numbers. Everyone's like, but he's buying Amazon. He must have lost his mind. He's crazy. By the way, how much is Amazon up since Buffett started buying Amazon a few years ago? A lot, right? A lot. And even today, if I look at straight, that was return on net assets. Let me look at just plain old EPS. Well, here's as reported EPS in 2018, 2019. Here's reality. Not only is EPS at Amazon on a uniform basis more than double what's reported, it's double and rising higher every year, unlike the as reported EPS number, which makes it look like it's, so-so, right? So at least no one's saying that Amazon doesn't make money anymore, but they don't realize how much money it's making. Now, I'm not telling you to go out and buy Amazon. I'm saying there's a reason why Buffett is buying it, and it isn't because it doesn't make money, right? That's what the GAAP or IFRS or PFRS numbers would tell you around the world. The company looks good or bad, and that's not reality. So here's 2021. He says, oh, by the way, this accounting thing, we don't think it's appropriate, but it's required because it's GAAP. And that's not the way to look at my company either. Do not give me heartache about using GAAP numbers looking at my company. It's wrong. And he said that again in the first 10 minutes because he doesn't want people asking questions about it. He said, there's no need. Reported earnings. You don't want to look at that final line. Well, if you don't look at reported earnings for an E, that means you cannot look at a PE. Everybody's studying PE multiples and telling each other, oh, this company's cheap, this company's expensive. Based on a PE multiple where the E is nonsense. All right. Charlie Munger. All right, accounting is a good starting place. It gives us the financials, but it's a crude approximation when they talk about earnings. Here's another 5 greatest investors on the planet ever. Here's Seth Klarman. Seth Klarman, there's a book called Security Analysis. Seth Klarman wrote the foreword, so clearly he follows in the footsteps of Ben Graham. Seth Klarman runs Baupost Group. Let's see, how did Baupost Group do? Woo, that's the blue line. That's Baupost. The red line is the S&P. So the S&P has been up a lot in the last 20 years. He is crushing it. He is destroying it, right, with his stock picking ability. And what does Seth Klarman say in his book called Margin of Safety? Oh, let's see. He said, analysis of reported earnings misleads investors as to what's really going on. That means the PE is wrong if the E is wrong. Let's see. He's buying eBay. He was the 3rd biggest holder of eBay, by the way. 3rd biggest holder. Of all the investors on the planet, he owned the 3rd biggest position, right? Why would he buy a company that has a return on assets that's GAAP earnings divided by GAAP assets of something as bad and low as what is it, 5%, 8%, not even 4%? Well, let's see what economic reality is. Ta-da! No, this company is getting, even today, is still getting a 25, 30% return on assets. Given a cost of capital of somewhere between, 6 and 12, that is a crazy, crazy, super profitable company, not a bad company the way GAAP, because people are looking at Seth Klarman going, oh, why is he buying eBay? This is not a good company. Just like they tag Buffett with, why are you buying Amazon? It's not a good company. So I guess it is. Yes, it is. It just doesn't look good in our GAAP. Let's see who else is on this list of great investors. Marty Whitman. There's a book called Security Analysis. Marty said, that's a great book, but it's outdated because it doesn't handle all the accounting issues that have occurred since this book was published. So I got to republish a book called, what did Marty call the book? He called it Modern Security Analysis. How creative. Anyway, he basically updated Ben Graham's book. And what did he say? Here's his performance. And what did he say? Let's see. Berkeley Group Holdings. Why is he, but this is a British company now, right? This is not US GAAP. Doesn't look like such a great company, 10% return. In reality, those are the returns. This is just before he passed away. So I'm showing he passed away a couple of years ago. And these are the returns of the firm. So no wonder he's buying this company. People don't think it's a good company. He knows it's an awesome company. And what did he say? Generally accepted accounting principles, not truth or reality. I'm this harsh, not truth or reality. Let's see, Jean-Marie Eviard, another investor in foreign stocks. Morningstar Fund Manager of the Decade Lifetime Achievement Award, Barron's Legendary Value Investors. And he said, I went to the bookstore and I bought this book, and then I bought this book. I bought these two books, and I was truly illuminated, meaning I follow what they tell me. I look at earning power and I adjust, right? So he's buying Omnicom Group. This is his firm, First Eagle. And let's see, looks like a bad company. In reality, phenomenal company, right? By the way, this orange number, that's what you see in Yahoo Finance or Google Finance. That's what you see, right? Now, he is known for being a foreign stock investor. Oh, by the way, they still like cheap PEs. They want high quality companies, but they want PEs that are cheap on a uniform basis, not on a GAAP basis. Jean-Marie Eviard was speaking at the Great CFA Society, this one in New York, and they asked him, Jean-Marie, do you adjust financials, you know, when you're investing in stocks? And he said, always restate financials when valuing companies. This means PFRS. This means IFRS. This means Singapore financial reporting standards. By the way, if IFRS was a standard, why does every country have its own version? I'm just asking. If IFRS was really a standard, why does SFRS exist? Why doesn't Singapore just call it IFRS? Why does PFRS exist? Why don't they just call it IFRS? Because it's different than IFRS. They adopt it differently. Why does China say, oh, we adopt IFRS, but we call it Chinese accounting standards? You're like, well, why would you do that if you adopt IFRS? Because we changed them. So this idea that all countries in the world are on this equal standard playing field of calculated earnings is just silly. So here's Philippine Stock Exchange, TEL, PLDT. I was asked in 2010 to do a conference for the CFA Philippines. And in 2010, I said, people are saying that PSE's TL stock, PLDT stock, look cheap, 10 times, 12 times earnings. And I said, well, that's on a PFRS basis. On a non-PFRS basis, its PE was something like, I don't know, 200 times, 400 times, meaning ridiculously expensive. And there were people saying, buy the stock. And we said, no, don't buy the stock because it's unbelievably expensive. The stock then underperformed. The orange is the PSCI, right? The Philippine Composite. The blue is PLDT stock. And why is it underperformed? Because it was actually quite expensive and earnings were not as high as PFRS numbers showed. It's not PLDT's fault that their earnings looks like that. Sometimes the earnings looks much, much higher, readily, right, understated versus reality. And sometimes it's readily overstated versus reality. In PLDT's case, it's overstated. The earnings number looks larger than it would under uniform accounting. I'm not saying they're not doing PFRS correctly. I think the auditors, right, SGV, are doing proper accounting of TEL. I'm not arguing that. I'm just saying when you convert to uniform, it's a really expensive company. Not 15 times multiples, but something like 100 times. Now, I'm not showing you today, right? I'm just saying this is what it looked like over the course of 7 years, right? As we were showing this information. Let's see. Uniform accounting. Where did this name come from? Did I make this up? Is this my invention? No, there's a guy named Shelby Davis. Shelby was president, the second president of the CFA Society, right, of New York. All these people are like, wow, this is all CFA-oriented presentation. Yes, second president. And he said, I've noticed companies aren't using and following the same accounting standards. Amazing. Even in the 1940s, he said, they're using different, some are using a FIFO, some are using LIFO. Some are capitalizing this way, some are capitalizing in a different way. Just like today, around the world is still the case, right? And he said, I think I have an idea. I'm going to borrow $50,000 from my wife. He didn't have the money. He didn't have the money. So his wife, she had the money, $50,000. He goes, if I invest by using this strategy where instead of allowing companies to report whatever they report, I'm going to adjust the financials just like all the great investors in history have said, I'm going to adjust the financials to get to a cleaner earnings number, right? And he took that 50 grand and he turned it to $850 million before he died. This is one of the greatest investors on the planet. 50,000, he turned to 850 million using the strategy of adjusting the financials. And the Davis funds, by the way, he taught that to his son, who then taught it to his grandson, Chris Davis. And Chris Davis, right, grandson of Shelby Davis, is now managing the Davis funds with over $100 billion. All right. And you can see still in their marketing information, they say, we look at earnings quality, which means we don't trust the earnings at face value. And what did Shelby call this strategy? What did Shelby, let's see, what did he call this strategy of adjusting earnings? What did he call it? Let's see, he called it, well, he had 14 articles in the CFA Financial Analyst Journal. He had speeches, and in all those, he called it, we need uniform accounting. We need uniform accounting. Did the accountants pay attention? No, because he's a finance guy. He wasn't president of the CPA Society. He was president of the CFA Society. So the accountants are like, yeah, you're a finance person. You know, we'll stick to our accounting stuff. And nobody in the accounting profession, most nobody, ever adopted this idea of uniform accounting. What you find, though, is adopted on the finance side of the world. So who's using uniform accounting? Believe it or not, of the 10 biggest investors on the planet, 9 of them have uniform accounting in-house, right? Many of them from us, from Valence, from my firm. Our firm's like 150 people. Anyway, it's a small boutique, but we're focused. 200 of the 300 biggest money managers in the world are using and reading our research on a regular basis. I mean, I can actually tell you the emails of the names of the people reading our research, right? Because they're all hitting our database. I mean, I wouldn't tell you, but I could if they allowed me to. BNY Mellon, the 8th biggest money manager on the entire planet, managing at the time almost $2 trillion with a T, 2 trillion. This is Dave Daglio, who was the CIO of $50 billion of equities. He ran active equities of $50 billion US dollars. Think about how big that is. And Mellon, by the way, is managing $550 billion of equities, including passives. And he's the CIO. And what did he say? He said, you know what? There's an incredible link between return on assets and valuations if you're using uniform accounting. If you're not, then really difficult, right? So everyone's like, what's uniform accounting? Well, I'm sorry, you know, that it's not being taught and the CPAs haven't adopted it. BlackRock, the #1 asset manager on the planet, the biggest by far. This is old. It's probably more like 8 trillion now or more. And Ron Kahn, who was a colleague of mine, an acquaintance. We email back and forth a couple times a year. What did Ron Kahn say? He doesn't call it uniform accounting. What he calls it is, we need to have earnings quality to understand the quality and sustainability of earnings of a company, which is the whole point of uniform accounting. He just doesn't want to call it that. He doesn't. But I know deep down it's uniform accounting. He just doesn't call it that because it's BlackRock. We're #1. We're not going to tell people what we're doing. We just tell people about earnings quality. So we have this cycle. Oh, by the way, in these 2 books, remember there's a credit cycle. Just to bring this back to the beginning, 1949, 1934, these 2 books, the terms debt and credit are mentioned more than 400 times. You cannot be a great equity investor without being a solid credit analyst. I actually don't know how people can read these 2 books so many times and walk away and just start doing EPS and PE analysis. It's kind of crazy. It's like, did you read the book or not? I don't know. So this is a more expanded view of a credit cycle and an earnings cycle and thinking about how they go into it. So it's obviously more detailed. There's one thing I should mention. The government can throw this entire thing off. It is possible for any government in the world to make the bull bear cycle do wacky things for long periods of time because the government can mess up credit. The government can tax companies to such a degree that they make no money, meaning they have no earnings. And this stuff can just pop out of nowhere. So taxation and the government's interest rate policies and currency policies can massively affect this. And it's one of those leading indicators we have to look at. So, by the way, people are saying, so how good is this at stock picking? This is the S&P 500. This is just, I'm just showing pandemic. Because if I show stuff pre-pandemic, people are like, oh, who knows? That was different because of the pandemic. So here's since the pandemic, our stock picks using uniform accounting and this top-down and bottom-up analysis have beaten our large cap picks, have beaten the S&P by, I think the S&P is up like 35%, and our picks are up like 80 just in this short time frame, 80, and that's large cap. But large cap is difficult because it's hard to find those great, awesome little companies. As Buffett would say, it's a structural advantage to not be managing. He's managing $290 billion, right? He goes, I have to hunt for elephants, is what he said. If I only had $1 million, I could make 50% a year. Meaning, I know it. He says, no, I know I could not. I think I could. I guarantee it. Meaning, if he could buy micro cap and small cap stocks, he would do much better. Well, amazingly, we have a micro cap stock picking product that we launched, and we do better than our large cap product. Naturally, as Buffett would say. How much better? Well, this is the Russell micro cap, which, as you can see, is up, I don't know, also about 25, 30%. And our micro cap picks using uniform accounting and everything we showed you are up 158% since we launched that product, even just last year. That's just in the last year during a pandemic. Now, well, the reason we are launching micro cap stocks and whatever is because our macro analysis, because of our credit analysis, was telling us that the US stock market was in a bull, was continuing a bull, and will continue to be in a bull. Right now, there are people saying, oh my God, the market's so expensive. Have you not looked at the last 200 years of markets? Markets get expensive, and they continue to get expensive until a credit crisis kicks in, right? And so you hear these people go, stock market's so expensive, it's ridiculous. Clearly, you haven't studied the greatest investors on the planet. Right? If you want to see a replay of my video, I just did an investment conference 2 weeks ago, 2 weeks and a day ago, at the Stansberry Investment Conference in Vegas. The video is available. It's 30 minutes, and it's actually all about microcap stock picking. And people have asked for that video. So if you go to futuremegacaps.com, you can see that replay from that conference. And with that, Rich, I will finish and take questions or have whatever discussion you'd like, whatever time we have. I don't even know where we are time-wise.
All right. Well, Joel, thank you so much for that amazing presentation. And I'm sure everybody here learned a lot. If you have any questions, just ask in the chat. I'll call them out. But as you sort of type it in, let's start with this, right? So, Joel, you talked about uniform accounting quite a bit in the latter half of the presentation. And I know your Twitter feed also posts some examples of you adjusting a couple of like Philippine equities as well to see the true earnings power. What are some of the most significant adjustments you do see vis-a-vis like PFRS that probably impact earnings power the most?
Well, in PFRS, I mean, one of the biggest ones, like with PLDT, is special items. The company takes special item charges, which sometimes are recurring and sometimes are truly non-recurring. And the problem is the accounting literature in US GAAP as well under PFRS allows way too much latitude for a company to take special impairments and special charges and whatever. And so what you find is PLDT tends to take some charges that are perfectly 100% allowed. I'm not saying they're doing anything wrong from an audit standpoint. I'm not saying the auditors are doing anything wrong. It's the problem is the rules. And the rules allow the company to take special charges, which sometimes are recurring, and sometimes you say non-recurring. Well, if it's truly non-recurring, then I would call it a special item also. But if it's a recurring charge, taken as a special item, I would rather reverse that out as a special item and call it a recurring item. But the accounting rules allow such latitude on this. It's not PLDT's fault, right? They're just following the guidance, right? The issue is US GAAP, IFRS, and on that issue, PFRS has adopted it the same way. So it's really unfortunate. Another big one for companies, not just PLDT, but for Globe and a lot of the firms, research and development expense has zero standardization. In the US, you have to expense 100% of research and development costs. Well, R&D is clearly an investment in the future. So why is it being expensed, right? And then in the US, they say, well, you don't expense it if you buy it. So this is just in the insanity of US accounting, right? Is that if you buy it, then you book it as an R&D intangible if you buy another company. But if you're not buying it, you're just spending it, then you don't book it as an intangible. Well, how on earth is this decent? Now, under IFRS, it's even worse because IFRS said, well, no, maybe you should capitalize some of the D, but not the R. And then they go to the company and say, how much of R&D is R and how much is D? And the company goes, all right. They have no idea. Maybe some biotech firm or some, telecom firm really understands how much of R&D is development versus research. Either way, they disclose it in the financials. It shows up in some note, and they said, well, this one company made 30% R&D, another company made 70%. One big one for Globe and PLDT that makes them incomparable on PFRS earnings is leases. The lease capitalization rules are so awful around the world. I'm not actually picking on PFRS. PFRS adopted the lease capitalization rules of IFRS and US GAAP. It's synonymous around and they're horrible. They're created terribly. It is not, any CFA on the planet would say, well, why are they doing this? This doesn't make any sense. Because you still have rules which allow some companies to treat an operating lease as a capital lease when another company with almost the identical lease treats as operating, right? They tried to create the standardization. Everyone's going to capitalize leases, and they murdered it. It's terrible. It's a terrible, ruling. And so those are three of the big ones. There's about 130 adjustments. Honestly, there's only 5 to 7 that matter per company. The problem is it's a different 5 to 7 from company to company. And even looking at Globe and PLDT, there are different accounting issues to get them to a comparability of earnings between Globe and PLD, because the PFRS earnings number is not comparable between those companies, which means the price to earnings multiple is not comparable, because people say, well, I think PLDT looks cheaper than Globe because their PE is cheaper, right? And you're like, well, if the earnings number is off, how can you even make that statement? And they're not off in the same way, right? They're off in grossly different ways.
No, absolutely. So that is super useful. And just to follow up to that, right, is because a lot of sell-side analysts, including myself formerly, don't use uniform adjusted accounting. We do use it based on the earnings reported of the company. And when you say that the market then makes moves because of this, and then how much alpha then you can generate by actually using the correct denominator, right?
Yeah, it's a tiny amount of alpha, though. I mean, it's a very, very small amount of alpha, right? Otherwise, every Wall Street analyst would be the next Buffett. How many Warren Buffetts, how many of the greatest investors on the planet have ever come from Wall Street? I can think of 2. Of hundreds of investors with fantastic alpha, how many have come from the sell side? Let's see. I can't. I mean, can you even name one? Can you name a great investor who's come from the sell side?
I cannot.
Right?
I cannot.
All right. Now, Wilson C., right, in the Philippines is a great investor. Chairman Lee at COL, also, I think, a great investor. But, they're as much on the buy side as they are publishing the research. And I'd argue they're more buy side than they are sell side all day long. And they both have a healthy respect for technical. I've studied both Wilson C. and Chairman Edward Lee at COL, Wilson at Wells Securities. I've studied how they invest and everything else, and I think they're both brilliant investors, but neither of them are sell-side analysts, are they? So even in the Philippines, I'd say, how many great investors are sell-side analysts? And I'd say, well, neither of them either. So as long as you're beholden to PFRS earnings analysis or whatever, you might get small amounts of alpha just in the trade. They beat earnings, and you see it slightly outperform. But once people figure out what's really going on, the stock then, right? Earnings beats create volatility. And if you're a good trader, you can generate some alpha from volatility. Yes, right? But over time, no, it's, you buy companies that are super high quality, that are very cheap. You hold them for a long period of time, and, you have the potential to make incredible returns. So
it's amazing. Now, maybe we have maybe room for one more question. So let me sort of go through the top-down approach that you mentioned a while ago. Obviously, you mentioned about credit crunch and using credit crisis as indicators of like market cycles and market shifts. And these patterns were done sort of in past when data was not available. But now that we have more sophisticated markets, do you think there are some leading indicators that we can take a look at to actually spot shifts in the market, whether turning from bull or bear?
Yeah, I mean, if we want to understand where the equity markets are headed, I mean, if I showed you the last 12 giant bear markets anywhere in the world, LATAM crisis, Asia financial crisis, the S&L crisis, right, in the US, the Great Recession, every one of those was preceded by a corporate credit crisis. The corporate credit crisis came first, and then the equity bear market hit. In fact, it's very hard to find any equity bear market ever that isn't preceded by a corporate credit crisis. So that means we have to really improve our credit and analytics. And today, luckily, we do have credit default swaps. We have credit indices. I wouldn't follow the work of S&P, Moody's, and Fitch because they've proven to be always lagging indicators on anywhere corporate credit. I'm not saying munis. I think Moody's, S&P, and Fitch can do wonderful municipal, government, other kinds of work. But in the era of corporate credit research, they're almost always behind the CDS markets. So if the rating always changes after the CDS markets have changed, why not just look at the CDS markets in the first place? What do I need the ratings for, right? Which is true, right? What do we need the ratings for if the ratings are always behind on CDS? So we do have data. Now, when John Moody started Moody's in the early 1900s, there were no CDSs. You couldn't just look up interest rates or interest rate swaps or see where rates were headed and whatever, and have all these wonderful markets to look at. So John Moody, when he started Moody's, was actually a phenomenal credit analyst, which was necessary for good equity investors to look at. I mean, he did great credit research. But for the first 40 years of Moody's, they did not accept money from the corporation that they were analyzing. Whereas today, all corporate credit is based on that. And so that's the big problem. So anyway, I don't know if I answered your question, but yeah, there's some wonderful indicators today that we can look at. But even if you didn't have them, Jesse Livermore didn't have any great CDS or technical indicators or whatever back in the 1920s, and he still made $100 million betting on when the market was going to collapse because he focused on the banks. That's what you do in the Philippines also. You focus on the banks, you focus on the currency, you look at the interest rates, and those things are all very healthy in the Philippines right now. They are, right?
They are.
That is very bullish for the Philippine stock market for the next couple of years. Very, very, very bullish. Now that credit's there, we just need earnings to catch up. Some of these lockdowns to end, the pandemic to be over, and we would expect to see, the more the pandemic opens and the country opens, we'd expect to see a bull market raging in the Philippines, much like we're seeing in the S&P, and will probably continue. Our call on the S&P is 30% higher between now and the end of 2022. Our
That's
call.
very promising. Yeah.
So
cool. Well, awesome. Well, Joel, thank you. I think that's all the time we have for questions. Thank you so much for the wonderful lecture. I'm sure everyone.
Thank you.
Yeah, appreciate your time.
Okay. On behalf of CFA Society Philippines, we'd just like to thank Dr. Joel and Rich for their time today. Allow us to present the e-certificate. So certificate of recognition. So to Professor Joel Litman and to Riche Lim for their very valuable contributions as speaker and moderator respectively for the session on top-down or bottom-up analysis, when and where to use at the Philippine Junior Finance and Investment Summit 2021. The future starts now. So thank you so much again, Dr. Joel and Rich, for your time today in this session. So much insights, especially that first one on the real backstory behind the bull and bear terminology. Thank you for reminding the audience on the misnomer.
Great.
So that's our
Thank you
session
so much.
for today. Let's just have a quick photo op, if that's okay. Precious,
Sure.
I'll wait for your countdown.
Okay, 1, 2, 3. Thank you.
Thank you so much. And that's our session for today. Before we wrap it up, allow us to announce the winner of the Guess the Logo answer. So may ganitong paraffle. Guess the Logo winner is Xavier Kabungkal. Congratulations to you. Please send us a message through the PJFIS Facebook page for instructions how to get your or redeem your call-funded certificate prize. And for everyone else, I just wanted to remind you guys again, please go to the CFA Society Philippines mobile app to complete your survey for day 1 of the summit. This is a requirement for you guys to get your e-certificate. And last but not least, allow us to thank again our sponsors and partners for today. Our platinum sponsor is MSCI Philippines. Our gold sponsors are AP Securities and Paul Financial Group. Our silver sponsors are Atram Trust, BBP Daiwa Capital Markets, and Papa Securities. We also want to thank our media partners, Business World and Business Mirror, and our event partners, the Bureau of the Treasury, the Philippine Stock Exchange, and the Securities and Exchange Commission. So we'll catch you guys again tomorrow for day 2 of PGFIS 2021, the future starts now. Thank you all and stay safe.